alongside the changes to the capital gains discount, switching it to indexation, they've also applied a minimum tax rate of 30% alongside that indexation, which is very, very interesting. And that's also applied to all assets, not to just property, all assets. So that was a huge spanner in the works, I'd say.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
All right, guys, welcome back to the Aussie Fire podcast. So in the last episode, if you listened to that one, we talked about the potential tax changes that were proposed in the upcoming budget. Well, as you listen to this episode, those changes have now been fully fleshed out, and that's what we're going to be discussing in today's episode. And although they're not law yet, we still have to be mindful that these things are only really proposals at this stage, and they still have to be passed through the Senate and all of that sort of thing. So usually there's a lot of pushback with some of these things, as you might imagine, as we'll get to the proposals themselves or the ideas that were fleshed out by the government. So we'll get into all of that today and how it might affect you as a listener, as an investor, and how it affects the FIRE community in general, and maybe even some things you can do to work with the new changes if they do come to pass, and the things that you can keep in mind.
Yeah, I think that's a great point you're starting with, Dave, around how these things are still in flux a little bit. Like, it's not just, the coalition, one day, I don't know who the hell's in the Senate at the moment. It's not just all the people in the Senate that aren't Labor, but it's also even Labor itself still making a lot of determinations. I've chatted to a few people I know are in Canberra, and they still have to carve out lots of exemptions that, they haven't gotten to in the initial budget. So it is also just sometimes they might not have made exceptions decided and made public. That's the other part of it. But yeah, definitely looking forward to chatting about it today. Were you watching the speech on budget night?
I watched a little bit of it. I got there a bit late, but I watched some of it. I watched the replay and then started reading about it in a bit more detail. I
watched it until, the news agency started actually reporting on the stuff, then I just turned it off.
When the reactions to it start happening.
Oh, once the data, I don't need the rhetoric, I don't want to listen to all the Australians are better off or whatever. Like, just tell me the numbers.
It gets pretty dramatic pretty quickly, doesn't it? Like with the...
It does. I mean, I guess the first question is, what surprised you? Did anything surprise you from what they came out with on budget night based on, the previous episode or what was in the media circulating over the weekend?
Yes, there were definitely some surprises there, which I don't know if we want to share those surprises right now or just flesh them out one by one.
Let's flesh them out and we can point them out as we go.
All right, so the first thing that you'll notice that was talked about, I guess, almost in a comedic way was the tax cuts, or what does they call it? Working Australian tax offset or something like that. It was like $250 per person, something like that. And as you can, if you combine those changes or that idea with some of the other changes, you're like, I'm not sure the mathing there. Like, I'm not sure. I mean, we'll get into it, but it just seemed like I don't think it really did what it set out to achieve. Let's say that.
I mean, I would describe what they tried to do with some of the tax cuts and stuff as like, it felt very BAU, or like business as usual governing that was wrapped up in a lot of rhetoric, was my initial reaction, right? So it's like, okay, yeah, it's good. There's tax bracket creep as wages get higher over time, things like this, like you need to adjust it slightly. It felt kind of like a thanks for doing your job more than it felt like a, thanks for the big prize was my kind of reaction to it.
All right, so since that one was a bit of a non-starter or a non-event, let's get into some of the bigger tax changes. And obviously there was a whole bunch of announcements involved with the budget, but we're going to be speaking mostly about how it impacts investing in general. So that's what our audience is interested in. So let's focus on one of the big changes, which was the change to capital gains tax, which we flagged in the previous episode.
Big one.
Now, yes, very big one. So essentially one of the ideas that was floated was the one that came to pass, which ended up being scrapping the 50% discount as of, I think it's July 2027, and replacing that with indexation, which doesn't sound too bad. on the surface, right? It depends on the growth rate of your asset and all that, whether you're going to end up paying more tax or less tax. But one of the confusions was, how does this affect someone who's invested like from the last 5 years up until this date and then going forward? So basically how it's going to work is the capital gains tax discount will be honored for the period you've invested in up until 2027. And then from that point on, whatever your returns are after that, your growth returns, that return will be indexed, or you'll only pay tax on the real return, let's say. So basically your cost base is going to be adjusted upwards slightly for tax purposes when it comes to calculating how much profit you'll have to pay on selling that asset in the future. Is that how you understood it, Hayden?
Yeah, exactly. From, July 1, 2027, I think it's important to note that, they've obviously chosen that date as well, because what it means is that for the typical Australian, they're not going to have to worry about this in terms of their own tax returns until late July, August, October 2028 at the earliest. Some people even 2029. And I think that's just a thing that's worth flagging with people, is that, this thing can feel very right now. But in terms of, if you did nothing, if you just went to sleep and you didn't care about the money, the administrative or the thinking overhead really does kick in like quite literally, a few years from now type of thing. But yeah, that's how I understood it as well. I was generally fairly supportive of the change. Just in general, I thought, I think my biggest gripe with it is I don't understand why they had to extend it beyond property. That's what has gotten me the most worked up, because, and what's clear as well is that they've said that for new builds, if you're building a new place, that, I think they've said you can apply either the 50% discount or the index-based stuff, right? So they've clearly made a precedent and say, hey, for things we're not trying to discourage, we are going to complicate the tax code. So what I don't quite get with it is there's lots of other productive investments that are good for Australians that aren't related to a housing crisis, that I don't see why they couldn't have just left that alone. Like they've already made commitments to complicating this tax code immensely. I'm very empathetic about the housing crisis for a lot of young people and trying to do things to curb the incentives for the, immense capital gains that happen on housing. I am empathetic that we need to change it going forward, that people who've already bought should be able to get that benefit, but we also don't want to kind of lock in this, intergenerational issue for decades to come if someone's, owned it for 10 years. So just on that indexation-based thing, I don't have major problems with it. I just wish it was maybe more focused on existing dwellings.
I don't have a problem with switching from the discount to indexation either. And I would say the majority of people probably don't care, because you would like to be taxed on your real gain. Like I think that part kind of intuitively makes sense. Yeah, because your purchasing power is increased. That's where you've gotten a genuine wealth benefit versus just like inflation or whatever, right? Just keeping up sort of thing.
Like what people forget about this is, there's going to be lots of people out there under this new model who pay less tax. If you buy an apartment, for instance, in Sydney, which is where I've been looking, and those things can sometimes grow at like 2% per annum, and you buy it next year, or you buy it on July 1, 2027, you're probably going to be better off under the new model, just based on historical inflation. So I think there's been a lot of doom and gloom on it, which I find ironic for housing, because in the grand scheme of things, housing is some of the slowest growth assets, compared to all the other assets, and everyone's kind of focused on like, oh, my house gains. It's like, my God, let's say inflation's 4%. Like if your property's only growing between 0 and 6% per annum, there's no reason to be panicking.
You might not pay any tax. If your growth rate is somewhere close to inflation, the tax on that's going to be very little.
Yeah, if your growth rate's at inflation, at CPI every year, starting from 2027, you will not pay any capital gains tax at all, according to what they've said. So yeah, sure, is the short answer I feel on that topic. Did you have any other things before we jump into the secret sauce they slipped in on the 30%?
No, so this is where the cynic part of me comes in. Like if, to what you're saying there, if the goal is to improve housing affordability, I'm not sure how you do that by increasing taxes on shares and crypto and businesses and all of the rest of it. And they've just taken a hammer to everything in a way. Like those things don't really... They're not going to make it easier for a younger person to buy a house, because ironically, that's what an increasing number of younger people are investing in, to then build up their house deposit so that they can buy if they're feeling that prices are like out of reach right now, and it's going to take them 5, 7, 10 years to build a deposit. So it does seem strange that if the goal was genuinely housing, why you would apply it to all assets. That does seem very odd. So that's why the cynic comes out and like, maybe it's more of a tax grab.
Honestly, talking to some people that have been in Canberra the last couple of days, like just friends of friends, because like gossip, me trying to find people who know what's going on.
I didn't know you had connections in Canberra, mate. So when you said about carving out exemptions, are you talking about for you in particular, or are you talking about what? Let me get a personal exemption.
Yeah, I think. Yeah, okay. We'll talk about exemptions a little bit. So just I don't have connections in Canberra. They let a lot of like people my age into kind of Canberra these days, right? To do lots of new age reporting. So
yeah, I saw that.
Yeah, you know, social media and stuff.
I got no interest in going there for that.
Just from what they've said, I have been surprised to the extent to which when they've been asking politicians questions, the politician's been very like, good question. We'll get back to you on that. So this is like whole cynic. Is it a tax grab? Is it a not tax grab? Sometimes I ponder if they've even thought about it that deeply, to be totally honest.
They slapped it together on Monday and announced it on Tuesday, you reckon?
I mean, they were speaking very openly about that they were constantly adjusting this budget based on probably the data mining they were doing. But in terms of the cynic part, you know, tax grab probably, I think the thing that annoys me is I wouldn't mind if they made it across the board if they had a broader overarching objective to simplify the tax code. But like, in my lifetime, at least, because, you know, I was born in the 90s, so I was like a child in the 90s. This is the most complicated wealth tax situation, you know, that we've dealt with. And that's difficult because, you know, a normal person was on the verge of not understanding the CGT discount sometimes because it's not what they're doing with their time and their days. And now it's like even more complicated. So again, my whole thing was like, I don't mind if you put it across the board if your objective was we need to keep it simple. But there's a lot of complicated stuff that's been going on, and that's before they start getting into all the other edge cases, for sure. But in terms of exemptions, the most relevant exemption in my circles, and it's not super interesting, so I'm not going to go on it too much, has been startup equity. You know, the whole argument has been, you know, venture capital and stuff, and it can be a bit of a tone-deaf conversation. I think the best explanation I've heard from some people in the space has been starting a company barely makes sense in the first place. Like, it's usually a bad idea, you know, and the rhetoric's been in the community like, you know, on day one, you're going to have a new business partner, the Australian government, who's going to own 45%. And it's like a bit overstated because obviously they use that number as like in a zero inflation. Yeah. But, you know, and I think the government's probably going to do something there. But like as an example, there's lots of people who go and, you know, they do the numbers and they think I'll start a business and I basically won't get an income. And, you know, it'll be worth it because one day I'll be able to sell the business and, you know, I'm able to make more money there. And there's two parts of me, right? There's the part of me that's like in my 30s in a startup. And then there's the part of me that's like the hyper left-leaning kid marching on the streets in Sydney in my early 20s, right? And I kind of get both arguments. But I always think with these things, it's like you want to tax the people with the money. That's how society does well, to the extent at which point they don't stop doing the thing. Who the hell knows what that is? But that's like one of the topics around. Basically, one of the biggest growth sectors in the Australian economy is people starting new businesses that employ people, businesses that create new things, businesses that are innovative in Australia. And you want to make sure you don't damage that too much. I have no opinion on the matter, except, you know, it should be thought about and considered. And whatever that outcome is, smarter people than me will figure it out. But that's like an example of one of the things they're still figuring out. You know, that's what Jim Chalmers has said, is like they're still trying to figure out stuff for small businesses as to, you know, whether they need to be more generous there. Because that makes sense. I mean, why the hell, if someone opens a chicken shop in your main street and starts employing people and serving your local community, and someone else has gone out there and taken out an investment loan on an existing house, you can't treat those two things the same in terms of what you want to incentivize or disincentivize, you know? That's the short story. That's the medium length story there, sorry.
No, it's true though. You want to be very careful about discouraging or reducing the incentives for people to start and grow businesses, because that's where jobs are going to come from, right? And you want those, if you're going to favor businesses, you would probably rather favor small businesses, because those are the ones who are going to struggle to make it the most and compete with larger businesses, right? Because there's obviously always like the permanent rhetoric around large companies not paying enough tax and all the rest of it, and then being increasingly difficult to get tax out of because they're so sophisticated in their structures and all the rest of it, which I think the government and the ATO is working on. They're making progress in that direction, but obviously they want to be a bit more gentle with like smaller businesses, right?
I trust that they'll get there. They've shown signals that they're still consulting. They've done the the loss carryback stuff for small businesses who made a profit and haven't made a profit in the they seem like they care, and I'm relatively optimistic that when it gets to the legislation part, it'll be reasonable.
Well, let's talk about something that, like you pointed out before, was just kind of slipped in there that nobody was really expecting, and that was alongside the changes to the capital gains discount, switching it to indexation, they've also applied a minimum tax rate of 30% alongside that indexation, which is very, very interesting. And that's also applied to all assets, not to just property, all assets. So that was a huge spanner in the works, I would say.
Yeah, I think that was the biggest update in the evening for me. And to be honest with you, I don't know why they didn't leak that. They leaked all the big stuff, Because I don't think anybody mentioned that before, right? I didn't hear that. No, that wasn't mentioned anywhere that I could find. And all the big policies. Yeah, exactly. And the only thing I can think of is, perhaps they knew that they would have made people think that they're complicating things as much as they are, And they were like, if we put that out as well, maybe everyone's going to have an actual aneurysm. Being like indexation, CPI, 1st of July, 30% floor on the marginal tax. I had a brain aneurysm on Tuesday night being like, what? And I had people doing media in Canberra sending me screenshots of the Treasury's calculations being like, I don't understand this. Treasury can't explain it to me well. Can you make sense of it? So it is complicated. I built a calculator for it. We'll put it in the show notes. Oh, yeah. I haven't shared it with you yet. It's been a whirlwind of it.
It's Thursday as we record. It's Thursday morning. It hasn't even been 48 hours yet since the budget.
Yeah, I built it on Tuesday night, and then I got my team at Pearl to make sure it's not going to put me in prison, and they okayed it. And then I put it on some Facebook groups. We'll share it in the show notes. It's basically it shows you the difference. It shows you if you bought assets 10 years ago based on historical CPI, how would it be different right now if you sold stuff, if the last 10 years were the new tax rules but applied backwards? So basically just gives you an alternative reality view, not because that's actually any math you'd use for your own finances, but it helps you get a more tactile understanding of the different scenarios and how this kind of behaves. For instance, as a good example, this whole 30% thing that Dave and I are talking about, it is quite literally that, typically, let's say you have no income and, you sell off investment property, you get a huge capital gain from that, it used to fall down in the marginal tax rate buckets, the 0 to 18,000 and then the 18,000 to 45 and, so to be 0%, 16%, 30%, 37%, 45%. The government's basically come along and scribbled out the 0% and written 30% and scribbled out the 16 and written 30 just for the capital gains part, which is it's very confusing because obviously if you go and earn $100 of income that year that you have no income, you're going to get taxed at the normal one. But yeah, basically right now, if someone says, how much tax am I going to pay when I sell my apartment or shares? The answer you have to give someone could be anything between 0 and 45% on any dollar. It would depend on your other, income and stuff that year. This change says, you asked me that question, how much am I going to pay on my capital gains? The answer is definitively anywhere between 30 and 45%, depending on your income. That's the short story.
Yeah, it's an odd one, and it's an odd one for a few reasons. So one of the things that was indicated that was the idea behind changing the taxes on investments, the spirit of it, let's say, was to tax investments closer to how wages are taxed so that investments are less, not incentivized, but less favored, right, in terms of tax treatment. But this actually goes even further than that and taxes the investment gains worse than wages. So it not only equalizes it, but it goes even further, right? Because if you're in a low income year or whatever and you sell off something, you're paying minimum 30%. Obviously, there's indexation to account for as well, but yeah, you're looking at you're looking at 30%. So it's a bit strange because then you have scenarios where, unless they're just trying to stop, I mean, if you look at it holistically, the entire budget, they're just basically trying to close down any form of tax optimization at all, because then they've got the trusts thing, which we can get into a bit later as well. So if you apply it broadly and look at it through that sort of a lens, you just see they're basically trying to say any form of income or earnings from investments, we'll get to income a bit later, but any form of gains from investments, they want to tax that between 30 and 47%, let's say. You shouldn't be able to get lower benefits for that.
So if we, we try and consolidate that, it's like this index-based CGT is really saying you might start to become increasingly worse off as your investments outperform inflation by 2 times or more. That's like the summary I've been giving people. When it comes to the 30% floor one, all that's really saying is that if you're selling stuff when your income's less than $45,000 a year, you're going to pay more tax on whatever the capital gain is than you used to. And it's important to point out, it really is that, I don't know if it's exactly 45,000, but it's around that 30% marginal tax rate. Most working Australians are not earning less than $45,000 a year if they're working full time. So like if you're working full time, and also if you have most Australians who, own a lot of capital, or at least enough capital, tend to be on higher annual salaries than that, right? So it's like if you're a full-time worker selling out stuff that year that you're working full-time, there's a very, very high chance that this 30% floor on the marginal tax rate is like not a topic for you. It's really for the people who are not earning income at the same time they're selling it. Now, again, to your point about tax optimization, I don't know if they're particularly targeting the FIRE community, but I doubt they're specifically targeting the FIRE community, but they're definitely trying to target people who they feel are very wealthy, build up a lot of wealth over a long time, defer a bunch of tax, and then very quietly sell things out without paying much tax either, right? Which I get in concept, but the thing I don't think I fully follow is like the people who are really taking advantage of the tax system are like selling off way more than 45 grand a year of capital gains, or even like at least leave the tax-free threshold there or something. You know what I mean? Even if they just said like, it's only tax-free for the first 10K of capital gains or something. The example that's been put to me a few times, and I've heard that Treasury has got no answer on this yet, is what about parental leave? That's been like a question I've heard. Or what about, people taking a year off, or people taking a break from work for mental health, like all these different kinds of things. It's like, what about the middle class people that say have shares and for one reason or another have to quit their job, or they want to quit their job and they're like, geez, how am I going to pay the bills? Maybe I'll sell down some ETFs. And now suddenly the government taxes that more, which, at first might not sound like a lot, but, particularly if you're a middle class person that's, been investing $10,000, $20,000 in ETFs, and now you need to sell those ETFs down and you've got a $20,000 gain on it, you're now looking at paying $6,000 more in tax that year as opposed to zero. And maybe they will get to the exemptions part. I haven't heard anything yet of, that's definitely firmed up. I don't know how they'd firm it up, which is probably part of their problem. It's a very tricky thing to wiggle with, but that seems to be the main thing. A lot of people are like, I work, the FIRE community and stuff, and we'll talk about that. But if people are out there with their hundreds of thousands of dollars of portfolios and they have years to figure this out, I think that's an inconvenience and an adjustment people need to make. And it's obviously not ideal. It's not ideal for me personally. I'm going to pay more tax, sure. Pay a lot of tax. I'm going to keep paying tax. Things happen, rules change. I do think the bigger thing on my mind is just, it does seem like it catches some people who've just got assets and are just trying to sell it to live off. And now they're being told like, haha, you're going to get a little bit more push because, we were chasing rich people or whatever we were trying to do with this.
Which is ironic because the rich people often, even if they have enormous levels of wealth, they have enough income still, even if they don't want it and they're trying to fucking hide it or whatever people are asserting that they're doing, they're still going to be paying 30% tax somewhere, and they've still got assets. If they sell any of those assets, you can damn well be sure they're going to be paying more than 30% already. And then they've often got things run through companies. They don't invest in their personal name. They're not even negative gearing, which we'll talk about in a minute. But like obscenely wealthy people are already paying like 30% plus tax. There's probably a few that have, some elaborate game of Cayman Islands, snakes and ladders, as I like to describe it. But for the most part, they're already going to be paying that. So it's more affecting the semi-wealthy people, right? Like the average people who have some assets and have some money.
Yeah, 100%. I agree. I have to be hopeful that the spirit of what Labor's tried to do so far seems to be genuine to me. Some of the execution seems sloppy, but I'm just hoping that in the spirit of trying to, be helpful to people and close tax loopholes and not kill the economy, I just hope that they figure out how to carve that out. A simple example, I still think just a tax-free threshold for CGT makes sense. Like, what rich person out there is going to be like, oh no, I have to pay 30% tax instead of 16% tax on all my capital gains between 19,000 and 45,000. Like, they'll be okay, whoever those people are. But yeah.
I don't think people would have a problem if they were paying like capital gains tax at their tax rate, just as they would if they were working as not working, because then it's equal to wages, right? So it depends how far you want to go in terms of punishing investments or disincentivizing investments relative to work. So yeah, it's going to depend on that. But we can get to that again. That's where the cynic part comes in, where they might have been a bit heavy-handed with it. They might change it, they might not. But to your point, if the spirit is trying to help, who is it helping and where is it helping? This is the part that I'm getting confused about. Because there's clearly like basically no improvement in income tax for lower or middle earners or whatever, right? So then who's it helping and where's the help? Like hurting someone else doesn't help the person who's in need of help, because the money just goes into a black hole.
Yeah, definitely. And if I could take this and then swing it, right, and talk about FIRE for a second, which I know we're going to talk about. Let's just say for argument's sake that there's two primary types of FIRE portfolios that exist right now. There's your A200, also your ASX 200 holders holding a lot of ASX. And there's your like S&P 500 holders holding a lot of growth assets, right? Like income versus growth thing. These rules don't really have much of an effect on the income or the ASX side. The CGT rules, ASX 200 is not growing at a certain rate. That's, that penal, if anything, it's better. The income is not capital gains. So it's not like this 30% floor is going to pay into it. So all of the topics, all of the chit chat so far in the last 48 hours has really been around the US, typically US. I say US growth, but I just mean growth assets. It's just US growth is the most common type of growth asset people are holding. And, with the S&P 500 returning these like 10% returns every year or something, the two biggest conversations tied to what we've talked about here have been oh no, I'm going to have to pay more tax on the capital gain under indexation, right? The quick example I give people is, let's say you're in a high tax bracket, for argument's sake, you earn 10%, 10 points of growth every year. Previously, maybe 2 of those points had to be paid in capital gains tax. Under the new rules, it looks like about 3 will be, so it's approximately, just from quick numbers, it's a really good ballpark, but it's going to vary per person, per income and stuff like that. But paying 10% extra tax of the total gains under the new indexation, going forward has been the number I've been using. That's topic 1 to chat about. And then topic 2 has been the people who are and I'm in this group very transparently, the people who are like, I will try and, buy growth assets and then I will try and sell them down later, like later on when I don't have an income. And therefore I'll be able to, take advantage of the lower marginal tax rates later on. And those people are suddenly like, oh my God, my strategy's dead. They've been the two kind of chit chat things I've heard of. Have you heard more than that, Dave? Or is that kind of the crux of it for you too?
No, those are the bulk of the situations. And then people are trying to think, well, if that happens, what do I do? Or then there's people in the other camp who are property investing. They're like, okay, now what? If I'm about to buy a property, do I still buy a property? Do I not buy a property? Do I switch to shares? But then shares are still kind of caught up in this, but then maybe there'll be changes later. Do I then max out my PPOR? Because that's the only thing that seems to be exempt and seems to always be exempt no matter what's happening. Do I then max out that and not worry about investing and then just downsize later? So we can get into that later. But on the property thing, there's also that the big change is negative gearing, which people have probably, a lot of you have probably read or heard about some of this before you're listening to us. So we do have to recap it just briefly for people who might not have been up to speed on it. So the negative gearing changes has been limited to new builds from the 1st of July 2027, and it's been grandfathered in full, which some people are happy about, some people are not happy about, for people who already own properties. And interestingly, it looks like if you already own a home of any kind, even if it's currently your home, you can rent that out in the future and you can negatively gear that in the future. So it basically, ironically, benefits all existing property owners and future non-property owners or people who currently don't own anything. They do not get those benefits, which kind of goes against the spirit of helping younger people who don't own homes. So it's a little bit of a sad irony, I guess, but you can see why they did it, because not grandfathering would upset a lot of the voter base. So there's that as well. And interestingly enough, with this negative gearing, you'll only be able to do it for new properties. But with negative gearing, unlike the capital gains changes where all assets have been caught up in this, with negative gearing, they've only changed it for property. So you'll still be able to negatively gear a share portfolio. You'll still be able to have margin loans and whatever, and you'll still be able to do debt recycling, which is an important point to consider, because people will maybe assume that because their loan is against their loan is against a property and they're negatively gearing, that they won't be able to debt recycle anymore. But it doesn't matter. Just like with deductibility, it doesn't matter what your loan is attached to. It matters what the purpose of the loan is. And so if the purpose of the loan is to invest in shares, then it's tax deductible. And then also with these changes, you'll still be able to negatively gear because it's for a share portfolio rather than an investment property.
Yeah, exactly. I think you've nailed it there. I have mixed feelings about this one. If I unpack a few different things, I was very pro in the last episode, allowing at least one property to be negatively geared. On budget night, I was very angry about that, more so because I genuinely have friends and people in my life that have used that as a genuine strategy to own a home. You know, I had a friend who had a low-paying job. They bought a 2-bedroom investment property. They negatively geared it because there was no way they could afford to pay the mortgage by living in it. They did that for 3 years, and then they got a better job, and then they could finally move into their home. I felt like that person was disenfranchised, but I've thought about this more, and I'm going to withhold my judgment on this a bit, because if you just think about it mathematically, the only reason to buy that property for that person is if they have a genuine belief that their ability to build wealth in non-leveraged, low interest assets cannot be, the pace of that cannot be met against housing. And basically, you only really need to negatively gear your future home and then move into it later if house price growth is high. If house price growth is not high, you can kind of just invest in other places or save and stuff. Like you can then just wait 3 years and then just buy the place anyway. Sure, it'll be more expensive, but your other wealth has increased even though it's not leveraged. So I think for me, it's kind of like, if this helps house prices, then I'm okay with it not, with an individual not being able to negatively gear at least one. If it doesn't help house prices, I think it will be a slam on young people who want to get into the property market. That's like big point one for me. I probably have more points, but I'll just see if you think that's too aggressive or not.
I see the point there. I mean, it comes back to everything's only attractive or a certain level of attractiveness relative to everything else, right? And with these changes, especially the capital gains tax changes, it makes buying a home even more attractive. It doesn't make share investing more attractive relative to property investing. If anything, they've carved out, well, there's special rules obviously for new property, which you get the benefits of all of those things still. So I'm not totally sure that it achieves its stated goal. It does take pressure off established property, most likely, which you could argue is a good thing, and it may funnel some investors into new property. So you could argue that it might have a potentially positive impact on supply, but yeah, carving out a rule for one property or something, I do think that would make sense because of the examples like you stated, Hayden. I think wealthy investors who like property will still be able to just hold negatively geared properties anyway, because those losses are able to be carried forward and offset against future gains. So I don't think, like, if you've got millions and millions of dollars and you like property investing, you can probably just keep investing in established property and you can just offset your future gains with the losses.
Yeah, if you have the capital up front, you got rich parents or something like that. That's a good example, right?
Well, if you're already a wealthy investor, It doesn't disincentivize those investors. Like, sure, they don't get as much of a tax break, but I don't think I think they're going to keep mostly investing as they were before, because I don't think that those people are going to be targeting new properties anyway. So I'm not convinced that because a lot of the anger and a lot of the annoyance and frustration with these kind of schemes or these kind of arrangements is that it's not the person with the one investment property. It's the person with 7 or 22 investment properties. So those people will just carry on.
Yeah. So, I mean, I've made my point clear on the whole, like, I only think it's a mistake to not even have one if house price growth isn't improved, you know? It doesn't need to improve a lot, but it probably needs to improve more than it's going to improve. So I'll probably end up being annoyed about that later anyway. I think in terms of like the grandfathering, it's one of those things that I still think is just reluctantly necessary.
Politically, especially.
Oh, it's just like, okay, my view on it, and this is again, you know, I don't work for Treasury. I run a finance startup and I think about money a lot, right? So I'm an idiot, always an important preface, but I would have preferred it if they phased out negative gearing over a long period of time.
That would work better, yeah.
I would prefer it, like when I say long period of time, I mean like, you know, several years. Like I'd prefer it if they were like, we're going to start capping deductions every year on negative gearing. We're not going to do anything till 2028 or 2029 or something. Then we're going to start capping it at, you know, 100 grand of deductions, you know, 60, you know, like just wean it off. And like, because, you know, I'm a firm believer that with several years of head, you know, lead time, people can solve their problems and deal with it, you know? And I know they didn't do that for political reasons, at least, you know, because they still need the voters. And it would have been a hard sell to make, I know, with the media and everything else. I don't mind them grandfathering people in. Like the idea that some young people were like, oh, you know, we should just cut negative gearing altogether next year. It's like, I get the spirit of that. Don't get me wrong. I get the spirit of that, especially someone who's negatively geared property. It's very easy for me to buy into that. But it's like, the other problem with negative gearing, and this is the one thing that has bugged the shit out of me, is the media are often like the government's choosing wealthy boomers. And what people like need to remember is that negative gearing property generally requires two things, is a simple explanation. Number one, it requires you to have not paid off a lot of the loan because your interest needs to be quite high to have big expenses, right? Like rent covers everything that isn't interest easily. And then it's like the interest that blows it out. So if you've paid off more of the mortgage or you've offset a lot of it, then the interest is low. So you need to have huge mortgage. The second one is you need to have decent income. You need to have like the median Australian income or higher generally. Like they're the people benefiting from it. And it's like, there's no freaking boomers that are doing that generally, right? Like a lot of the boomers who own a lot of property, they paid the thing off. They're just getting rental income, you know? They've already got their benefit. So, and this isn't to say that I'm like, pro negative gearing. It's more like, and I haven't looked at the data, this is just anecdotal, but it's like most of the people that are going to be benefiting off negative gearing are like 30 and 40-year-olds who have medium to high incomes, who have a few properties, who still have tons of like loans to pay off. They're not your battlers. They often are going to have young kids. They're often going to be young people contributing to the economy. The boomers are not part of the negative gearing conversation. And I kind of hate that rhetoric because it distracts from understanding the actual problem. And it's like, so that's also, I'm a little bit more empathetic about, you know, at least keeping it for several years if that was how the policy was. Because it's like, these are real working people a lot of the time. And yeah, some of them are privileged, some of them are lucky, some of them are taking advantage of the system, but they're not just rich people who got a free roll in life and are on the beach right now, not working.
Yeah, it's again, it's a bit ironic in a couple of ways. I would agree with you in terms of phasing it out. I think that could, instead of grandfathering, that would probably be, if you really wanted to change it, that would be a fairer way to do it. Like you could phase it out over 5 years or something where after a year, you only get 80% of the benefit and then 60% of the benefit. And then, you know, you could kind of wean people off that way. But yeah, it's a bit ironic that the ones who are going to be benefiting from negative gearing are, by definition, people who have not owned property for a long time. Because if you've owned property for a long time, it's way more likely to be positively geared and you'll probably be paying tax on it then. So the way the media likes to spin things, because they like to create two groups of people and make one group of people hate the other group of people. But it's so, like, society doesn't really work like that. And this is part of the thing that annoys me, is creating these two groups that hate each other is obviously good for content, to be perfectly honest. And that's why they do it, because it's good for clicks and outrage and all the rest of it. But yeah, it's different in the real world because, yeah, most of the people who are benefiting are not going to be old. Like, you know, you'd have people who are like 57 and they're like leveraged to the hill, just bought 5 negatively geared investment properties and they're going to invest for the next 5 years and then they're going to sell it because they would have already started that a long time ago. It's the people who have just...
It's a good lesson, yeah, for anyone who's listening. Like, both sides of politics will have a general tendency to highlight edge cases and go crazy with it. You know, the right-wing side will always take that random person on Centrelink who's gone and like bought themselves a Ferrari, right? And the left of politics will always take that random rich person who's got 12 investment properties, and they'll always take fringes to try and emphasize their point. That's just a good lesson for anyone who hasn't really kind of considered that before. But you're right about all of that, Dave. I think the one you mentioned about, you know, like I have an apartment, and I think it has been confirmed now that I could move out of this and rent it out. And if I was to make a loss on the rental, I could negatively get that. At first, I was like, my initial reaction to that was that seems a bit silly. And you should kind of like just say, once it stops being an investment property, it's done. Like you basically can't convert it back to an investment property. I probably softened my view on that slightly, mostly because I probably have started to reflect on some people I know that had planned to turn it into an investment property. The most obvious case I can think about that's probably common enough isn't quite me, because I never planned to rent this out, but it's people who like moved into a home that they bought trying to use like a government scheme, like a stamp duty exemption. They nearly never wanted to live there. They just did that to save money or take advantage of a government scheme. And then their plan was to wait the 12 months and then get the hell out of there and go rent or move back with their parents or something, you know? I mean, if they moved back with their parents, they probably just never moved in the first place and stayed at home or something, you know? But it's like, that might have been a pathway to people. And if you told them that you can't do the math of what you thought you could when you bought it, I could see how that might be a bit unfair. And there's probably a ridiculous amount of edge cases. I wouldn't even know how they would police that, because it's like, what about people who've gotten their loan approved and have just moved out, but or the other way around, you know, like they've moved out and they're about to put it on the market. Like, what's the date cutoff for that? So I kind of get in a way why, even if that was something that interested people, it would nearly be impossible to do. The only thing I could think about is to maybe put something in the future and say, you know, after July 1, 2028, you know, everything that's not an investment property currently and negatively geared can't be converted to one if you live in it, or something like that, because then, you know, people have like a lead time to deal with it. They can make decisions around it. There's not really people out there who should be saying, oh, my plan was to live in this for 5 years and then rent it out. Like, I don't really come across that much. And those people are fine anyway, you know, they don't. Yeah, so I'm kind of indifferent about that a little bit, but I could kind of understand if someone was like even I've thought about this a bit. I'm like, it feels really weird that if like I have lots of friends that own stuff, Dave, and I have a lot of friends that don't own stuff. And I'm like, it feels really weird that if I moved out of this place and into somewhere else, and I had a friend who bought an investment property like next door, that I could negatively gear this place. Like, that does feel a little bit unfair to the system.
Yes. That's the ironic part again. They've used the anger from people who don't own property to push in changes that negatively benefit or negatively affect those people who don't own property, and lock in the benefits for people who do own property. Because like you said, just because you own a year earlier or 2 years earlier and then you go and rent later, your friend can't do the same thing, even though you're both basically doing the same thing with the same property, just because you happen to own it on a certain date. So it's weird. It's weird that they've taken that anger and used it to then create policies that then negatively affect that same person that they're supposedly trying to help.
Well, sometimes I wonder if they were better off just saying like, these policies are to help all the babies, you know? Like, because...
What do you mean?
Well, like all the kids that are like 5, in the sense of like...
Because you're leaving a generation to wash through.
Kind of,
no
yeah,
one's had that
a little
benefit.
bit. Like, it does feel a little bit like it's not really going to help the 20-year-olds that are struggling. It's going to kind of... It's trying to cool off the market and create a more equitable scenario without any meaningful wealth transfer. And that'll just mean that there'll be the 2-tier system for a while, you know, in a sense. But I mean, that's easy to say because I'll just change the policy in 20 years anyway for some other reason. So
it'll be more equitable in 25 years' time, you reckon?
I don't know. It's a very big thing to say, but it does feel a lot more just like that the disparity that, you know, I might feel with someone who's 40 years older than me. That disparity might not exist with someone who's 40 years younger than me in 40 years.
I find the whole intergenerational thing annoying anyway, because of course there's always going to be a big difference between someone who's 20 and someone who's 60. They've had so much longer to accumulate assets. There's always going to be a massive gap. So the idea that the generation should somehow be equal or even close to equal is absolutely bananas.
But no, I get that. I've had this recently where I'll like be talking to like a 22-year-old who's like 10 years younger than me or something. And I'll tell them how much money I have. And they'll be like, oh my God, you're so rich. You know, and they'll get like this. And I'll like the 10 years of like misery that I've experienced that they haven't yet just like flashes past my eyeballs. And I'm like, oh yes, that's right. Being alive for a while tends to do that. You know, like it, it just, I hope if there's anyone who's young here listening, and I do talk to people who are younger and they're like, I feel so dejected. I'm like, honest to God, you just have to like lock in and work hard for a while and forget about the money.
They've been convinced that it's not possible though. This is why I hate the media so much.
But like, I didn't think it was possible. And then I just like, I remember working for 3 years and barely thinking about my money. And then I woke up one day and started counting it. And I was like, oh, that's not nothing. That ability of just time and hard work, you know. I don't know.
But that's because you also didn't buy into the narrative that you need to enjoy all your money now because you have no hope of getting anywhere in the future. We could probably do a whole episode.
Yeah, and the argument people make is boomers didn't have to work that hard. You know, like people aren't mad because old people have money. They're mad because they think they didn't earn it relative to what young people have to do to earn it. But that's the topic that we're not exploring. Also, quickly, Dave, do you think we should put a picture of you up on this podcast episode on Spotify that just has like a caption that says, I'm voting for One Nation? Do you think that'll be good clickbait? That'll be.
Does clickbait work on podcast platforms?
Probably not.
I wouldn't think so.
So you're right about the negative gearing not applying to shares and stuff too. I mean, that's great. I think obviously, like I think that makes sense. Apply it to where there's a problem. The most interesting thing I've seen is a lot of rhetoric online in the last couple of days where people are like, the negative gearing changes are the end of debt recycling. And I think people are just warming into this and they're struggling to conflate, like they're conflating things. And it's like debt recycling a portfolio has no difference. You know, like what people are getting mixed up on is that.
No, it does though.
But the assets that you are investing in, like whether you're debt recycling or not debt recycling assets, that's the problem. Like the problem is the assets. The problem is the CGT on the assets. You know, the problem is not the negative gearing, so to speak. I think what's hard is when someone says like debt recycling is not worth it. That's been what's bugging me. And it's like debt recycling's a tax strategy when you have a primary place of residence. But what's not worth it, or what people are worried about isn't worth it, is a lot of people who are saying, it's what I'm doing, is I'm invested in growth assets, which often creates the negative gearing in the first place. And those growth assets are going to be taxed more. But that has nothing to do with debt recycling. Like whether you have a portfolio with growth assets or whether you have a portfolio on a loan against the house that's growth assets, that's the same problem. You know, debt recycling is just around, if you've got a net loss on the interest, then that's still the case. So anytime someone says, at least from what I've read or understood, debt recycling is not worth it anymore, it's a silly thing to say, because the real conversation is like, are low income growth assets worth it anymore, which has nothing to do with debt recycling, which is a fair question, right? Because but nothing to do with debt recycling. But that's the earlier thing we were talking about around how people with FIRE might have to adjust to that.
No, that's a good point. Yeah, it's interesting. We can probably talk. Do you want to talk now about how different strategies might be affected?
Yeah,
then? Probably a good time to bring that up. So obviously one of the most popular methods of investing, like you pointed to, Hayden, in the FIRE community is high growth, lower yield investments, which tend to lean towards US shares, global shares, and less of Aussie shares. But what's interesting is because of the capital gains tax changes specifically, it's no longer going to be very efficient at all, to be honest, to then sell off your global shares to then live off that income in retirement, because you won't really get the benefits of the lower tax brackets. So it then becomes more appealing to have a dividend leaning portfolio, because then all of those dividends will fall into the 0 bracket, to the 16 bracket, and all the rest of it. So you get that benefit. So it really does damage the strategy that people have been focused on for a while now, but you'll get the benefits up until 2027, right? So it doesn't really destroy the strategy itself. So you'll still be able to retire. You'll pay a little bit more tax, which is not fun, let's say, but it doesn't kill it entirely. It just means that going forward, like if you zoom forward 10 years and these changes come in and they stay the same, then it's going to be more efficient to live off a dividend-focused portfolio.
Yeah, 100%. And I think a healthy way to think about this is not so much like people talk a lot about should I like sell my stuff and rebuy my stuff. If you've been owning ETFs for a while, right? Like a lot of the ETFs I own right now, I think most of them got purchased, 1 to 2 years ago. I'm going to hold them by the time the tax change comes in. I'm going to hold them for, another 3 or 2 years now. And then who knows what's going to happen after that. The effect of like selling some of my IVV and then rebuying VAS with it, it's probably very difficult to, like you'd have to really do some numbers and take some guesses as to the effect of the tax drag of that to reallocate your portfolio. So I think just a helpful piece of advice to encourage people to think about is don't overthink what you own. Think about what you're going to buy going forward, because that's, Dave would agree. It's like that you can control and there's no tax drag element. Because every time I sell that IVV, I'm going to have to pay 15% tax, CGT discount or whatever it is anyway. That's 15% upfront of cash that's not invested anymore. And it's like, yeah, sure, 30% marginal tax rate floor, CGT changes, all of that. I haven't done the numbers, and I'm not saying it's better or worse. It's more just like it's not trivial. So it is going forward.
That's the funny part. Like people start to think in very dramatic terms. Like even when when A200 came out, everyone's like, I'm selling my VAS, I'm buying A200. It's like, dude, it's like
save $30
pennies on the dollar. Yeah. Oh my God. You're paying all that tax just to switch to something that's slightly more efficient. So I do think this change will be a bit bigger than that. I'm just saying that for dramatic purposes, because it's the same mindset, right? It's like something happens and then there's a dramatic effect in their mind, like, oh, I need to switch to something else now. This other thing's cooked. Let me just switch everything over here.
The way I think about it too is I said this to a few people yesterday. The tax rule changes on CGT. Before the changes, you had a certain risk of, IVV or S&P 500 going bad in terms of the impact on you financially. You had a risk to that. After the changes, your risk is the same. You have the same downside risk, same worst case risk. Before the changes, you had a certain amount of upside potential in terms of the, dollars in your pocket. After the changes, you have less upside potential. And if you can think about it in those kinds of 4 quadrants, it's a really helpful way to be like, it's not binary. It's just like the trade-off is different, right? It's like, I don't do sports bet or stuff, so I might not use the right analogy, but it's just like the betting odds are slightly different. And, someone's asked me, I think I do about 75-25 in like growth income. So 75 growth. I would probably, under these rules, aim to shift that slightly to maybe like 70-30 or 65-35 or 60-40. I'd still be in heavy growth stuff because the upside case is still pretty good. I really do believe in, a lot of what's going on in the US right now. The growth stocks are still advantageous. I still think even with the tax changes, on the average case, it's going to outperform, but we're all still, I don't want to use the word gambling, but, investing is nothing's guaranteed, right? So it just shifts the risk model a little bit. That's how I've approached it, at least, Dave.
I think that's a healthy way to think about it because it's all, like you said, it's a game of probabilities essentially, right? So if you still expect the US to outperform the Australian market, for example, by like even 1% per annum over the long run, now that's a bet that you're making, but I would hazard a guess that that's probably going to be more impactful over a 20-year period than these tax changes when you go to then live off that portfolio later, which might cost you, a few grand a year in retirement and in extra tax. So the performance of your asset's always going to be a way bigger determinant of your outcome than the tax you're paying on that asset. And the tax changes, while they're not ideal, they're not dramatic to the point where it's obviously a no-brainer to just dump your growth assets and invest only for income. Because like you said, people think about it in these binary terms, like it's either this one's the best or this one's the best. And there's not really, much wiggle room in between. But this just makes dividend-focused investing a bit more efficient when it comes to living off a portfolio. So you may just want to lean your portfolio slightly more that way than you did before. That's all. I wouldn't say it's, one or the other.
I kind of want to see what this sounds kind of a bit 4D, but the other part of me that makes me worried is like, I'm not an economist, but I know that taxing capital more aggressively, we'll see how it's legislated, but I know taxing capital more aggressively is not a great way to stimulate the economy, right? Yeah, so it's like the other part of me is like, oh, I should go really hard on the ASX, but then I'm like, wait, so there's a tax policy change that makes it more difficult for businesses to grow. So I'll sell my ETFs or I'll buy new ETFs in the economy that's making it more difficult for businesses to grow. It's like, so I'm not, just to be clear to people listening, I'm not doing anything yet. It's Thursday, the 14th of May. I have to save up some money for a tax bill. So it's like, I'm not going to be investing for the next few months anyway. None of these changes really come in until next year, and I don't have hard, firm thoughts made up on this stuff yet. All I know is that, growth assets are proportionally less appealing, generally speaking. That's the only thing I've kind of come away with so far.
And I mean, you've played with you built your own calculator within a few hours, which is a little bit. I mean, that's a little bit extreme. I just sat there looking at the ceiling, thinking about it for a while. You're out there building a calculator, but if we had to put some numbers to it, I mean, obviously if you got 20 grand of dividends, that'll just flow through to your tax-free threshold, and you won't pay anything on that. But if you've got 20 grand of capital gains, that'll likely generate a 6 grand tax bill. So if you've got a couple doing that, then you're looking at 12 grand tax versus no tax. That's fairly substantial. That's the equivalent of having 300 grand of assets, right? Returning 4% per year. So that is fairly substantial and fairly annoying. So I would say if your goal is like 1.5 million in shares, maybe now it needs to be 1.8, right? So that might mean an extra 2 or 3 years worth of work. So that's fairly significant for the FIRE community if the changes take hold and if they stay in place for the next 10 or 15 years as you're doing that, as you're running that process to its final conclusion, let's say. Is that roughly what you were finding from the calculator, Hayden?
Yeah, for sure. That all sounds about right. I think this really does largely affect people who are able to buy a portfolio and then never touch it. If I want to buy a house one day, I'm going to have to sell this stuff anyway. It's going to get reallocated anyway, at some point. Because, I have to sell it out for a house deposit. And then as I build up and then maybe debt recycle in the future, I'll probably want to buy a different thing by then because you learn all the time. So again, I'm not overthinking it too much because life has a great way of just shifting stuff around, probably buy a little bit more income along the way now. But again, want to kind of see what the mood of all this settles at.
And that applies to trust as well. Obviously, if a couple, it's somewhat common, not massively done, but somewhat common that a couple own their investments in a trust, and now that trust is going to be forced to pay 30% tax regardless of who it's distributing the money to. So that same example applies, right? If you were earning 40 grand of dividends in a trust and you had 20 grand for you and 20 grand for your spouse before, you would pay no tax. And now you're going to be paying 12 grand tax. So that really kind of torpedoes that plan. You do get a tax credit, but it's a non-refundable tax credit, apparently. So, I mean, you get a credit for it, but that money's gone basically. And if you've got some weird rule is if you've got like a company, a corporate beneficiary, the tax credit does not transfer to the corporate beneficiary. So it's potentially, if you've got like one of these bucket companies, you're going to be paying 55 or 60% tax. So either that's an oversight or they want to get rid of the idea of a bucket company entirely.
Yeah, I don't want to pretend I'm hyper educated on this topic. I did have a family trust at one point. I did distribute income of ETFs I had to a family member. That family member was already in the 30% tax bracket anyway. They were income earning. But I do know people, particularly as I get older and I try and work my way up professionally, who, if they got big assets in their big family rich pool and, they send it out to all their 18-year-old kids or their uncles who aren't working again or whatever to avoid paying tax and stuff. And I don't lament them for it. I think everyone should use what they can to, the idea of saying, the tax system exists, but you shouldn't use it is like a battle to know, you just can't, it goes nowhere. That conversation goes nowhere. So it's I'm glad that the government is doing things so that smart people or people with money aren't incentivized to do stuff, as anyone in their situation would be. That probably isn't fair if you think about it very abstractly, right? Just because they have money or access or accountants or whatever, they're not doing stuff that's wildly complicated. If a random couple earning money wanted to just be hey, can we just put our money here and then we'll just send it to both of us? Because I bought it in my name because we were just investing. We didn't really think about it like that. They shouldn't be punished because they're not educated on that stuff. So generally, I think that's a good change. One question I did have for you, Dave, which I wasn't sure if we would get around to, is, and I still think it's early days, but I do like that this is an interesting swing back to motivating superannuation, because nothing has changed in the super engine for tax at all. So super proportionally back to the risk thing again.
Not this month.
Not this month. Yeah, not this year.
They only just had changes to super.
I mean, the government did flag, I don't know if it was in the budget announcement or if it was just generally, they did flag that they're trying to make super nice. But I do think it's interesting. I think, this budget does also, what it will do, just like how we said, you finitely might be less interested in growth stocks. The average person is going to both finitely be more interested in making concessional contributions because you'll just get taxed 15% flat. And, later on when you pull that money out, there's tax advantages there. In theory, assuming nothing changes in all those typical disclaimers, which some people are more skeptical than others, Dave. And also non-concessional contributions for the same thing. So once again, it's like, this isn't saying everyone should go and move all their money into super. It's, just saying if someone was, had a risk tolerance where they were putting 5% of their money into super, of the pool of money that they thought they would need after 60-ish, maybe instead of 5%, it's somewhere between 5 and 10%. That's like just on a mathematical basis what these kinds of things push people to do.
It does push people to do that. I still think people are trying to get over the idea of the constant rule changes. I think every time you change a rule, you damage trust of that thing that you're changing the rule on. You damage confidence in that thing, especially when they've basically tried to bring in an unrealized capital gains tax, which I think that has spooked a lot of people. It does make super more attractive, these changes, but I think that there's still some sort of hangover about the previous, super changes that they tried to get through that didn't end up getting through in full and got watered down. I think they're still dealing with the damaged trust with that, but it does make it more attractive. It makes loading up your place of residence more attractive instead of maybe downsizing later. It makes income assets more attractive. Maybe someone said, I saw this described as the most boomer budget ever because it just encourages like dividend stocks and living off rental income and buying stuff and never selling it and all this. So I thought that was quite fun.
That is pretty fun.
But it does, yeah. It just, if you're going to buy a rental property, maybe you look at a more income-focused rental property so you can just pay it off and then live off the rent rather than the traditional investor model for property has been damaged quite a bit. I do think it will still carry on just because of there is some logic to it and some popularity for good reason where it's like you buy a property, it's relatively low yield, but in a, sort of high quality location that you expect to grow in value a lot over the next 20 years. And then you sell it later when you need the money or whatever, but it was never going to be a good income asset to live off. That kind of changes a bit now where people might want to focus more on an asset that's going to produce a decent level of income. And maybe they move towards newer builds, but newer builds have their own risks attached to them, as we know from apartment buildings of the last 20 years. And then you also get developers pricing it in. If there's more demand for new property than established property, then that'll get priced in. And so you won't necessarily get a massive benefit there. So it's tricky.
There's other things they're going to have to do as well. Like they surely are going to have to allow negative gearing before the build's complete. Like I don't see how someone can take out a construction loan or whatever and then get no tax benefit for 2 years.
Yeah, I think if it's an investor, most investors will probably just buy like off the plan or something like that rather than build it yourself and you have to wait and you have to make installments.
That makes sense. So Dave, we're getting pretty close to the end of this marathon episode. Is there anything else you have on your mind just before we wrap up?
Not really. I think we've covered, almost everything we need to cover. We could probably do a follow-up episode covering the other things that we didn't cover in this episode because there is quite a lot, maybe including some calculations and some scenarios and things like that. But the other thing that's worth mentioning, I think, is a lot of people like the idea of rent vesting in this community, right? And this does damage that idea somewhat. But if you were to buy a property to live in and then you wanted to be a rent investor, you didn't really want to own it, you wanted to keep renting yourself and just have an investment property, you can still basically use the 6-year exemption for your place of residence on capital gains tax. So you could buy a home to live in, and then you live in it for a while, then you move out, and then you turn it into a rental. And for 6 years, you could still basically sell it without paying capital gains tax. So if you wanted to be a rent investor, you could still do that, and it's worth keeping that in mind. There's a potential benefit there that might not be obvious at first. What about yourself, mate? Is there anything else we haven't really covered you want to mention at this point?
I think probably just I made this comment about venture capital and startups earlier. And if anyone's interested in that, I know we've got a techie community sometimes, but it doesn't really impact people with companies because they've held the companies for a long time. Most of the people in the community complaining about it are not complaining about their own money or their own wealth, because they'll be fine. They have established businesses, just like people who've had a house for 10 years. They're mostly the rhetoric has been very under these rules, I would not have started my company if I started today. That's what they're saying. I think that's an important thing, because it's not really a bunch of people complaining about how it's going to impact them, particularly business owners that have had the business for a while. It's very much feeling empathy for it. Obviously, venture capital and people who fund these businesses are going to be slightly more selfishly motivated because they're obviously trying to do this for many decades. So they obviously want to, keep getting good returns. But yeah, for small business owners, if you hear them complaining about it, it's mostly probably the entrepreneur in them that thinks about what they might do in the future, or what, they hope other people can do like them. But again, I'm still pretty hopeful just from the stuff Labor's said that they'll be good for the engine room of the economy, right? Which is where we always need to focus our stuff. But it's been a good chat, Dave. Hopefully people have found it interesting. Hopefully people are engaged. If you have, any other thoughts about anything we've said, feel free to leave it in the comments. If you have anything that you disagree with, we'd love to hear that in the comments even more. Some of our favorite comments. But otherwise, you can, leave a comment anytime. Or if you have questions, thoughts, you can always reach out to us on social media, Strong Money Australia or Perla, or you can email us at hello@aussiefirepod.com. But otherwise, it's been a real pleasure chatting to you, Dave, about the most exhilarating topic known to man, the 2026 budget. Hope everyone's doing well out there. Don't stress.
Thanks for listening, guys.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorised representative, number 1281540 of Sandland Private Wealth, Pty Ltd, with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.